This is the solution to assignment 3. It starts with a question about the relationship between NPV and stock price, which is a fundamental concept in finance. Okay? The reason why NPV and stock prices are equivalent, it really is because they are mathematically equivalent. It's the same formula, right? To compute an NPV, you discount the incremental cash flows to a project, right? Whereas to compute a stock price, you discount cash flows to the company, okay? So if markets are efficient, then you know both calculations should be equivalent, right? The stock price recognizes all the future cash flows to the company, so the market should also recognize the incremental cash flows to a project and adjust the stock price exactly to the amount of the NPV of the project. Okay, so NPV and stock prices are equivalent because of that. If the markets are not efficient, right, then of course the stock price may not reflect the NPV, right? Because the stock price may be reflecting other things other than future cash flows, right? And then, you know, since the NPV always requires you to discount future incremental cash flows, then NPV and stock prices are going to be different. Okay, so that's why efficient markets are important. Question 2 is just to remind you that the only thing that we are sure with NPV is shareholder value maximization, right? NPV does not ensure that we're going to eliminate conflicts with society, right? That's a simple point, but it's worth emphasizing. For example, you know, a cheap technology may maximize NPV because of lower costs, but it might be bad for the environment at the same time, right? Or, you know, we can think of situations where a company that wants to be socially responsible may need to pass on positive NPV projects because they are bad for society, because they hurt stakeholders, right? And for other consequences. Okay, so NPV does not assure that companies are doing the best for society because of this potential conflict. Question 3 is a little bit of a trick question, but it's important for you to know. Okay, so it's a situation when the discount rate is lower than the growth rate, right? The growth rate is 7%, the discount rate is 5%, and if you just apply the growing perpetuity formula, it seems that the NPV is negative, which makes no sense, right? You know, if the asset has a very high growth rate, this should be a great asset. Okay. The answer, in fact, is that, you know, the asset has an infinite value. Okay. If you're mathematically inclined, you probably know that. But the intuitive way to think about it is that if the cash flow is growing at a faster rate than the discount rate, then every year the discounted cash flow for that year is getting bigger and bigger. Okay, it's not converging to a small number, right? And what this is going to do is that if you sum all future cash flows, the answer is going to blow up. It's going to become infinite. Okay? The bottom line is that we know infinite does not exist in the real world, right? Nothing has an infinite value. So if you do find an infinite value in a present value calculation, it means you've done something wrong. You have to go back and rethink your estimates. Maybe you overestimated growth rates, maybe you underestimated discount rates. Okay? Question 4 is to remind you of the important relationship between the rate of return, the IRR, and the discount rate. Okay? So the idea that NPV equals 0 is equivalent to having a rate of return greater than the discount rate. If the IRR is bigger than the discount rate, then the NPV is positive. Okay? However, remember that the IRR should not be computed if you see a negative cash flow following a positive one. Those are the cases when you can have multiple IRRs, and it really might get you in trouble if you try to compute IRR in those cases. So if you see that, just use NPV, and also be careful when you're using IRR to compute two different investments, right? As we discussed in the lecture notes, if the investments are of different magnitude, then the IRR may give you the wrong comparison. Okay? As long as you remember these conditions, you should be able to employ this important idea, which is the equivalence between the IRR rule and the NPV rule. Question 5 is an application of the notion of incremental cash flows. It's a problem that really asks you to think about what incremental cash flows are. What's this notion of incremental cash flow? Okay, it's a project where a company is building a new, is thinking about starting to sell a new wallet. Okay, and as usual, there is an initial outlay, and the company has estimated wallet cash flows as $450,000 a year. Okay, the question is, are these the right cash flows? You know, you might know already, obviously not, right? There are 6 slides coming up. Okay, so those are not the right cash flows. There's something else missing, right? What is missing here is that we haven't fully considered the notion of incremental cash flows. Okay, remember that the notion of incremental cash flows is this important notion of new minus old. In order to figure out the right cash flows, the right NPV for the project, we have to take into account all consequences of taking a new project. Okay, and this particular exercise is talking about erosion, which is a very common consequence of starting a new project in a company, right? If a company starts a related project, or if you improve an existing project, you know, you're creating new cash flows, but you're also reducing sales of existing products. Okay? In this case, we assume that the sales are going to decrease cash flow by 200. Okay? However, we are not done, right? Because we also have to think about competitors. You know, competitors are also trying to think about cool new products, so they might decide to produce a wallet, right? A similar wallet, and which might erode sales anyway. Okay? And you know, to really think about this problem, we have to be very careful and really model this notion of new minus old. So that's what I have for you here. Okay? Let's really go line by line and think about what changes if you go from no wallet to a new to the wallet project. Okay, so of course the wallet cash flows alone are 450, right? And you erode if you sell wallets, you're going to erode 200. Okay, if you don't start the wallet, you know, your own erosion is 0, right? However, there is this additional line here, which is that if you don't start the wallet, you know, your expectation is that your competitors are going to start a wallet anyway. Okay, the erosion is not as big as if it was your own wallet, so it's 100, it's not 200, but it's significant, right? You have to take that into account. Okay, competitors are going to erode your cash flows anyway, right? If you do take the wallet, what is happening is that the erosion is going down, right? Okay, the erosion of existing cash flows from competitors is going down from 100 to 50. Okay, the assumption here is that competitors might also, you know, they might decide to start a wallet anyway. Even if you start your own project, the competitors may also decide to come into the market. So the erosion from competitors doesn't go to 0, okay, but it is going down, right? So your wallet project is also reducing erosion from competitors. This is a third consequence of the project that we have to take into account, right? So new cash flows from the wallet, your own erosion, and erosion from competitors. Okay? After you do all that, you will quickly see that the incremental cash flow is 300, right? So you erode 200, okay, but you reduce erosion from your competitors by 50. So the bottom line is that the total incremental cash flow for the wallet project is 300. So those are the cash flows that you would discount. This question doesn't ask you to compute NPV because the idea was to allow you to think, spend the time thinking about how to build the cash flows. Okay, so that's the right answer right there. Question 6 is about opportunity costs. This is what you should have figured out here. Okay, the net present value of a full-time MBA is going to depend heavily on your opportunity cost. Okay, in the case of the MBA, of course, the opportunity cost is going to come from the need that, you know, if you're going to take a full-time MBA, you're going to have to quit your job, right? The total cost of the project is 400, and you're going to increase your lifetime earnings by 700, right? But the NPV is not 300, okay? The NPV would be 300 minus whatever is your, whatever you expect to be the reduction in your current earnings, right? So if you're going to have to quit your job and you make $100,000 a year, okay, after taxes, then you're going to have to deduct 200 from the NPV. If you make more money, then of course the NPV is going to become lower, right? So that's why it's important when you think about, doing a full-time MBA or any type of education, you have to think about what sort of other opportunities I'm missing. If you're working, right, as most people who take a full-time MBA are currently working, then you have to think about what you're missing in terms of your current salary. That's a very good illustration of this notion of opportunity cost. Okay? Then you had a question about R&D, right? In question 7, the R&D that you had to model is slightly different from what we considered in class, right? Which is the R&D to gather more information about an existing drug that is already viable, right? In the lecture notes, we considered an R&D to create a viable drug. Now you have a viable drug, but you have the opportunity to do additional research to try to increase the NPV of the drug, okay? Of course, doing the R&D is going to require you to wait as well, right? On top of spending more cash, you're going to have to wait a year. So this is a combination of R&D valuation and the option to wait, okay? So the trade-off in this case is that waiting is going to cost you 10 million, okay? And it's going to reduce the NPV if the research is not successful, right? Notice that while the NPV is still 200 million next year is worth less than 200 million today, okay? Why? Because the company is foregoing the drug cash flow by 1 year. Foregoing the drug cash flow in the current year by waiting, okay? So that's why that's a very, again, it's a notion of opportunity cost. So if you launch today using the problem's numbers, you get an NPV of 200. If you launch tomorrow, right, if the research is successful, the NPV goes up to 250, okay? If you fail, it's kind of the same drug, you're going to go back to the NPV of 200, okay? So you can use the formula that we used in class to compute the NPV, 30% times 250, 7% times 200, discounted back to times 0, you get an NPV of 185.45, okay? So since the NPV of R&D plus launch is lower than the NPV of launching today, the right decision would be to launch today and not do additional R&D, okay? Question 8 is a question about the option to abandon a project, okay? So it's a conceptual question to make sure that you understand this notion of, what does it mean? What's the benefit of being able to abandon a project, right? One thing is that if the cost of abandoning a project is 0, then you would never wait, okay? Why? Let's think about it now. The benefit, of course, of waiting, as we discussed in the lecture notes, is that you can avoid the loss, right? So if the project becomes unprofitable, in our case, the gold price goes down, then opening the mine is going to create a loss. If you wait until next year, you can avoid that loss, right? The benefit of waiting is that the cost of waiting is that if you wait, of course, you're foregoing the current profit. So by opening now, you get the current profit. If you wait, you're going to get 0 today, okay? So what happens? If the cost of closing the mine is 0, right, then what you can easily figure out is that, you can eliminate the loss, right? If you open now and close tomorrow, right, you can eliminate the loss, right? So instead of a loss here, you get a 0, okay? And you also get the current profit, okay? And in addition, in the good state of the world, when the gold price goes up, the profit is the same as in the case of waiting, right? So now you have a situation where really you can get the best of both worlds, right? You can get the current profit and you can get 0 tomorrow if the gold price goes down, okay? So what this means is that if it was costless to open and, start and abandon projects, then companies would never wait, right? And this is the solution in words, right? The idea is that if the cost of closing the mine is 0, then you can also achieve this payoff of 0 by closing tomorrow, right? So that's why I call this the best of both worlds. Finally, question 9 was about this notion of irreversible investment, right? So, and it's related to what we just discussed, right? An irreversible investment is the opposite, right, of a 0 cost of abandoning. Is an investment that once you start it, it's very hard to go back, okay? So just using our current discussion, it's obvious that, it is for these types of investments that the option to wait is going to have a high value, right? If it's very difficult for a company to go back and abandon a project, then it may be it pays off more to wait until to make sure that you have all relevant information before you commit cash to this investment.